NASDAQ 100 calls that were marked down from $16.40 on the high to $7, with the last bid and ask at $5.50 by $9.40, but the last print was at $8, and there's our markdown. Now, we'll be watching our $2,600 call as once the markdown of minus 10.60 is what value of this markdown MMTs does it get on the opening bell gap in the NASDAQ 100 futures. However, Apple missed its earnings, so these futures are going to trade a little bit different because Apple's got a big peg to it now. So we're going to peg these contracts now. Just remember that this was a big supporter. I think it's 16% weighted, but don't quote me on it. It's something you can look up, to the NASDAQ 100. And that Google buying the call side at support pays money. Apple, on the other hand, is going to be the first day, and these NASDAQ 100 575 puts that were marked up, the last print was 23.10, the high was 23.10, the low was 23.10. Well, I can tell you right now, I want alarm set at $15.50 if it falls below $15.50, because I'm going to watch and see how much of that markdown. These only trade for 2 days. 2 days during this weekly expiration, and they're tradable on both sides. So with the gap up, I'm going to be watching how much premium they take out of here on the 25.75. I'm going to watch over here on that $2,600 call of where that markdown was and how to trade index call and puts based on the overall index trend. For you public people, we're market makers, and we'll teach you a little bit different than that, but nonetheless, it is always going to be price action. Price action is the most important thing about this business. How they mark them down and how you buy them wholesale and sell it back to the public. How to trade $2,600 call. Volatility. Gap open up price volatility. So we'll be watching that. And we'll be watching how Apple performs with the NASDAQ 100 and how the weighting of the NASDAQ 100 could possibly change. But what would replace Apple, the trend that Apple was in a very, very, very long, and it still is, don't get me wrong. It's just that right now, it's a left elbow gap down. You're going to have some people who sell and some people who buy, but it's going to make the NASDAQ 100 right here, NASDAQ 100, and we have a huge gap in all the futures today. And we're going to see how this one performs with the NASDAQ 100 call side, put side. I will feature that 818 $2,500 put. It was buyable at $12 and already made that whopper, okay? It already made that whopper. That's right, all that big money right there. Not only that, I will tell you, I'm still watching that $2,500 put within the price structure of Ben Bernanke and the broader market, and how much of that markup of 25.60, I mean, that, look at that, 10.60, you got a markup. Right here. Okay? So that's what we're going to be watching. And the reasons why is just like that one got marked. Here's Apple. Here is the $2,500 put. That's a monthly expiration now. This is a weekly. This is tradable for 2 days. But you can see the markdown was 10.60 in the $2,600 call. You can see that the 818 well below the market, the $2,500 put, that was over 100 points below the market using a monthly contract, paid big money by buying down there between $12 and $15, $16. and then selling within the trend. But today, we're going to look at where that next price action will come into play. So on this one here, I'm going to set alarms that falls below 2250, 1870, and 1560 just to have the alarm structures in the price set up with MMTs. And once again, it's how they take the premium here. They added premium here. Today, they take the premium out, and they're going to add. But look at the spreads. They're both there. We're experts in electronic trading in the options market and how to trade whether S&P or NASDAQ 100 options, calls and puts, and various other instruments. Is that we key in directly at where that top end resistance and lower support levels are going to be, but how those call and puts respond in the middle of that price action, and where those are tradable within their price ranges on entry and exits. So once again, how do I take premium out of a NASDAQ 100, and how do I give premium to a put option that was well below 100 points? And how do I trade that? And how do I get a gain out of here? Well, we did it. Now, when you make that kind of gain over here and you sell it, you buy the lower end over here. So on gap up days, you're in that volatility hook so that you get paid. Whether it does it or not, you're not going to lose money because you already made enough money on the $2,500 index put using the 818 and a 2,500 strike. Put means go down in value, and the market sold off for 3 days. And now you got a gap open up today. And the time is 5:54 a.m. This is live at 7/25/2012. Pre-market. Gap up, right dead in the middle of the earnings season, right dead in the middle of Bernanke going to want to do QE3, right dead in the middle of the turmoil, the worldwide financial meltdown. It doesn't matter. Price is price. High-frequency trading models in index options are a different way of doing business than when you were just trading options the traditional way. The prices of the premiums have changed significantly. That's something you need to learn. And so this is what we're going to be watching as far as index, NASDAQ 100 index options.